The silver market is experiencing something we haven't seen in decades. While everyone's distracted by the headlines, a perfect storm is quietly building that could send silver prices into territory most people think is impossible. And the clock is ticking faster than you might realize. Let me show you what's really happening behind the scenes, because what I'm about to reveal isn't being discussed in mainstream financial media. They're either missing it completely or they don't want you to know. Silver just broke through a critical resistance level that held for years. We're watching price action that mirrors some of the most explosive moves in precious metals history. But here's what makes this different. This isn't speculation. This isn't hype. This is fundamental supply and demand economics playing out in real time. And the math is absolutely brutal for anyone caught on the wrong side. Think about what silver actually is for a moment. It's not just a precious metal. It's an industrial metal that's absolutely critical to modern technology. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. 5G infrastructure, medical devices, electronics, water purification. The list goes on and on. And here's the kicker. Unlike gold, most of the silver that gets used industrially is gone forever. It's consumed in tiny amounts across millions of products and never recovered. Now layer on top of that the investment demand. Central banks around the world are diversifying away from dollar-denominated assets. We're watching a fundamental shift in the global monetary system, and precious metals are at the center of it. But while everyone focuses on gold, silver is setting up for something potentially far more explosive because of its dual nature as both an industrial and monetary metal. Let me paint you a picture of what's happening in the physical market right now. Dealers are reporting premiums on physical silver that we haven't seen outside of crisis periods. When you go to buy actual silver coins or bars, you're paying significantly above the spot price. That spread tells you something critical. There's a disconnect between the paper price and the physical price. The futures market, where most of the price discovery happens, is showing one thing. But when you try to actually get your hands on physical metal, you're discovering the real price is much higher. Before we go further, I want to make sure you have access to something I put together. There's a free guide in the description that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It covers strategies that most financial advisors won't tell you about. Grab that while you're here. Now, let's talk about what happened the last time silver made a major move. Back in the late 70s and early 80s, silver went from single digits to over $40 an ounce in a remarkably short period. What drove that? A combination of inflation fears, currency debasement, and yes, some market manipulation by the Hunt brothers. But strip away the manipulation part and you're left with the same fundamental drivers we're seeing today. Loss of confidence in fiat currency, inflation eating away at purchasing power, people scrambling for real assets. Fast forward to 2011. Silver rallied from around $17 to nearly $50 in less than a year. What triggered that move? The aftermath of the financial crisis, massive money printing by central banks, zero interest rate policies, investors fleeing to hard assets. Sound familiar? Because we're living through an even more extreme version of those same conditions right now. But here's what most people miss when they look at those historical moves. They focus on the peak prices and think that's the story. The real story is what happened in the supply and demand fundamentals leading up to those moves. In both cases, you had years of underinvestment in mining. You had industrial demand steadily increasing. You had investment demand suddenly surging. And you had a physical market that couldn't keep up with the paper market's promises. Let's dig into the supply side because this is where things get really interesting. Silver mining is not like flipping a switch. When prices are low, mines shut down, exploration stops, new projects don't get funded. It takes years, sometimes a decade or more, to bring a new mine online. And here's the problem. We've had years of underinvestment in silver mining. The easy deposits have been mined. The ore grades are declining. The costs are rising. And many of the world's largest silver mines are actually byproducts of other mining operations. They're not even primarily silver mines. What does that mean? It means that even if silver prices double or triple, you can't just magically increase supply overnight. The supply response is slow, painfully slow. Meanwhile, demand is accelerating. Solar panel installations are breaking records. Electric vehicle production is ramping up globally. Electronics demand continues to grow. And now you're adding investment demand on top of that. Let me give you some numbers that should make you sit up and pay attention. Global silver mine production has been essentially flat for years. We're talking about roughly 800 million ounces annually. Industrial demand alone is consuming around 600 million ounces. Investment demand and jewelry take up most of the rest. The market has been in deficit, meaning we're consuming more than we're producing, and that deficit is being filled by above-ground stockpiles. But here's where it gets critical. Those above-ground stockpiles aren't infinite, and a significant portion of them are held by investors who have no intention of selling at current prices. They're waiting. They understand what's coming. So the available supply for industrial users and new investors is actually much tighter than the headline numbers suggest. Now let's talk about what's happening in the derivatives market, because this is where things could get explosive. The COMEX, where silver futures are traded, operates on a fractional reserve system. There are far more paper claims on silver than there is actual physical silver backing those claims. As long as everyone's playing the paper game, the system works. But what happens when people start demanding physical delivery? We've already seen stress in this system. There have been periods where the spreads between different contract months blew out, where delivery delays occurred, where premiums on physical metal spiked. These are warning signs. They're telling you that the paper market and the physical market are starting to diverge. And when that divergence becomes too great, something has to give. Think about what happened in the nickel market recently. Prices went absolutely parabolic because of a short squeeze. Trading had to be halted. Contracts had to be canceled. It was chaos. Now imagine that happening in silver, but with the added complexity of it being a monetary metal that investors around the world are trying to acquire as a store of value. The potential for a squeeze in silver makes what happened in nickel look tame by comparison. Let's talk about the elephant in the room, the short position in silver. There are massive short positions held by commercial banks and other large institutions. These aren't small speculative shorts. We're talking about positions that represent a significant percentage of annual global production. Now, as long as prices stay contained, those shorts are manageable. But if prices start to run, those shorts have to be covered. And covering a short position means buying, which pushes prices higher, which forces more covering. You see where this goes. This is the setup for what traders call a short squeeze. And in a market as relatively small as silver, a short squeeze can send prices to levels that seem absurd until they happen. Remember, the entire global silver market is tiny compared to other asset classes. The total value of all the silver ever mined is a fraction of the market cap of a single large tech company. It doesn't take much capital flowing into silver to move the silver market just crossed a threshold that most investors won't recognize until it's too late. While everyone's been watching the headlines, something extraordinary has been building beneath the surface, the kind of setup that only happens once every few decades. And right now we're watching the final pieces fall into place. Let me show you what's really happening here, because this isn't just another price rally. This is a fundamental restructuring of the silver market that's been years in the making. And the implications are staggering. Silver has been climbing steadily, breaking through resistance levels that held for years. But here's what most people miss. The price action you're seeing on your screen, that's just the symptom. The real story is happening in the physical market, in the vaults, in the supply chains, and in the decisions being made by the world's largest institutions right now. Think about this for a second. Silver is the only metal that's both a monetary asset and an industrial commodity. It's in your phone, your solar panels, your electric vehicles, your medical equipment. Every single day, industrial demand is consuming silver that can never be recovered. It's gone, permanently. And at the same time, investors are waking up to what central banks figured out thousands of years ago. Real money is tangible. It's something you can hold. Now here's where it gets interesting. The supply situation for silver is unlike anything we've seen in modern markets. Mining production has been essentially flat for years. You can't just flip a switch and produce more silver. It takes 7 to 10 years to bring a new mine online. 7 to 10 years. And nobody's been investing in new production because for decades, silver was suppressed, undervalued, treated like an afterthought. But demand is exploding. The solar industry alone is consuming record amounts of silver, Every solar panel requires silver paste for conductivity. There's no substitute that works as well. Electric vehicles use significantly more silver than traditional cars. The green energy transition that governments worldwide are pushing, it runs on silver. And that demand is only accelerating. Here's a number that should make you sit up and pay attention. Industrial demand for silver has been outpacing mine supply for years now. Years. So where's the silver coming from? Existing stockpiles, above ground inventories, and those inventories are draining, fast. The COMEX warehouses, where the paper silver market operates, have been seeing dramatic drawdowns. Registered silver, the stuff that's actually available for delivery, has been dropping to levels that would have been unthinkable a few years ago. And when you look at the ratio of paper claims to physical silver, it's staggering. There are far more claims on silver than there is actual metal to back them up. This is the setup. This is what happens before a market breaks. You have massive paper claims, dwindling physical supply, and surging demand from both industrial users and investors who are starting to understand what's coming. Now let me take you back to a moment in history that rhymes with what we're seeing today. In the late 70s, silver went from around $5 an ounce to $50 in a matter of months. $50. That's a 10 times move. And it wasn't because of some speculative frenzy, although that certainly added fuel to the fire. It was because the fundamentals had reached a breaking point. The Hunt brothers understood what was happening with the supply and demand dynamics, and they started accumulating physical silver, massive amounts of it. What happened next was legendary. As they took delivery of physical metal, the paper market started to crack. The exchanges changed the rules mid-game, but the price had already exploded. And here's the key lesson from that era. When the physical market tightens, when people start demanding actual delivery instead of paper promises, the price discovery mechanism breaks down. Prices don't move in orderly fashion. They gap. They spike. They move in ways that seem impossible until they happen. Fast forward to today, and we're seeing echoes of that same dynamic, but on a much larger scale. The difference is, back then, it was primarily investment demand driving the squeeze. Today, you have industrial demand that's non-negotiable. Solar manufacturers need silver. EV makers need silver. Electronics companies need silver. They can't just decide to stop buying because the price goes up. They have to have it. And on top of that industrial demand, you now have a growing wave of investors who are looking at the monetary system and asking themselves a very simple question. What happens when the currency loses value? What happens when the debt becomes unsustainable? What happens when the system that we've all taken for granted starts to show cracks? Before I go further, I want to share something with you. I've put together a free guide that breaks down the savings secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. This guide shows you strategies that most people never hear about until it's too late. Check it out when you get a chance. Now, back to what's happening in the silver market. Let's talk about the elephant in the room, the gold to silver ratio. Historically, this ratio has averaged somewhere between 15 to 1 and 60 to 1. There have been times when it's gone to extremes, like during the 2020 crisis, when it briefly touched 100 to 1. But over the long term, it reverts to a mean. Right now, even with silver's recent gains, the ratio is still elevated compared to historical norms. What does that tell you? It tells you that silver is still undervalued relative to gold. And when you consider that silver has more industrial applications than gold, that it's consumed rather than just stored, the case for silver becomes even more compelling. But here's what really keeps me up at night. The derivatives market. The paper silver market is enormous compared to the physical market. Banks and institutions have created a complex web of derivatives, futures contracts, and options that dwarf the actual physical supply. This works fine, as long as everyone's content to settle in cash. But what happens when people start demanding physical delivery? We've already seen glimpses of this. There have been moments when the spread between paper silver and physical silver widened dramatically, when you couldn't buy physical coins or bars at anywhere near the spot price. Premiums spiked. Delivery times stretched from days to weeks to months. That's not normal market behavior. That's a market under stress. And the stress is building. Central banks around the world have been buying gold at record pace. They understand that in a world of unlimited currency creation, hard assets matter. But here's the thing about central banks. They move slowly. They're like giant ships that take miles to turn. By the time central banks are buying, the smart money has already positioned itself. Individual investors, family offices, hedge funds, they're starting to look at silver and see what the institutions will eventually be forced to acknowledge. This is one of the most asymmetric opportunities in the market today. The downside is limited. Silver has industrial value. It has monetary value. It's not going to zero. But the upside is enormous. Think about what $50 silver means. That's not some wild fantasy number. We've been there before. And given the supply and demand fundamentals today, given the monetary environment we're in, $50 might just be the beginning. Some analysts are talking about triple digits, $100 silver. And when you look at the math, when you look at the deficit between supply and demand, when you look at the amount of currency that's been created, it's not as crazy as it sounds. Here's a thought experiment. What if just 1% of global investment portfolios decided to allocate to physical silver? Just 1%. The amount of available silver would be consumed almost instantly. There isn't enough physical silver in the world to satisfy that level of demand at current prices. So what happens? Prices adjust dramatically. This is what I mean by asymmetric. You're not betting on some speculative bubble. You're positioning yourself ahead of a fundamental supply and demand imbalance that has to resolve itself. And the only way it resolves is through higher prices, much higher prices. Now let's talk about what's happening in the mining sector, because this is crucial to understanding where we're headed. Silver miners have been underinvesting in new production for years. Why? Because silver prices were too low to justify the capital expenditure. Mining is expensive, it's risky, and when prices are suppressed, companies focus on existing operations rather than developing new ones. But here's the problem. Existing mines deplete, ore grades decline. Production naturally falls over time unless you're constantly developing new resources, and that development hasn't been happening. So even as demand has been rising, the supply response has been muted. We're now at a point where even if miners wanted to ramp up production, they couldn't do it quickly. The lead times are too long. This creates a situation where the market is going to have to ration demand through price. There's no other mechanism. You can't create silver out of thin air. You can't print it like currency. The only way to balance supply and demand when you have a structural deficit is through price appreciation that either stimulates new supply or destroys demand. And given the industrial applications, demand is relatively inelastic. Solar panel manufacturers aren't going to stop building panels because silver goes up 20%. They'll pay the higher price and pass it on to consumers. Let me paint you a picture of what this looks like in practice. Imagine you're a procurement manager for a major electronics company. You need silver for your manufacturing process. It's not optional. Your entire production line depends on it. You've been buying silver at relatively stable prices for years, but suddenly the price starts moving. Not just moving, but really moving. Up 10% in a week, then another 10%. Your suppliers are telling you that physical delivery times are extending. Premiums are rising. What do? You panic buy. You secure supply at whatever price you can get because the alternative is shutting down your production line. And when you do that, when procurement managers across multiple industries start panic buying, that's when prices really take off. That's when the market goes vertical. We saw a preview of this during the supply chain disruptions of recent years. When physical silver became hard to source, premiums exploded. People were paying 30, 40, even 50% over spot price for physical coins and bars. The paper price said one thing, but the real-world price was completely different. That disconnect is a warning sign. It's telling you that the paper market is losing its grip on price discovery. And here's where it gets really interesting. The COMEX, the exchange where silver futures trade, has a provision that allows them to settle contracts in cash if they can't deliver physical metal. Think about that for a second. The exchange that's supposed to be the price discovery mechanism for silver has a built-in escape hatch that says, if we run out of silver, we'll just pay you cash instead. What do you think happens to confidence in that market when people realize that their contracts might not be backed by actual metal? What happens when the big players, the ones moving serious money, decide they want physical delivery and they're not going to accept cash settlement? The whole structure starts to crack. This is why I keep coming back to the fundamentals. Forget the charts for a minute. Forget the technical analysis. Just look at the basic equation. Supply is constrained and falling. Demand is rising and accelerating. Inventories are draining. The paper market is over-leveraged. And the price is still, by historical standards, relatively low. That's not a market that's going to drift sideways. That's a market that's going to break. And when it breaks, it's going to move fast. Now, I want to address something important here, especially for those of you who are thinking about your retirement, about protecting the wealth you've spent decades building. We're living in unprecedented times. The amount of debt in the system, the monetary experiments being run by central banks, the geopolitical tensions, the potential for market dislocations, these aren't abstract concerns. They're real risks that could impact your financial security. If you're sitting on $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold IRAs work. It's in the description. This guide walks you through how you can get physical precious metals into your retirement account without triggering tax penalties. It covers the rules, the process, the custodians, everything you need to know. This isn't about fear-mongering. It's about having options. It's about diversification that actually means something when markets get volatile. Worth checking out if that's relevant to your situation. All right, back to the silver story, because we're just getting to the really fascinating part. Let's talk about what happens when this market actually breaks, when the squeeze really kicks in, because there are historical precedents, and they're instructive. Go back to the nickel market in early 2022. Nickel, another industrial metal, saw a massive short squeeze on the London Metal Exchange. Prices went from around $25,000 a ton to over $100,000 a ton in a matter of hours. 100,000. The exchange had to halt trading. They canceled trades. They changed the rules. It was chaos. Now, nickel isn't silver. The markets are different. But the lesson is the same. When you have a physical commodity with tight supply, and you have a paper market with excessive leverage, and something triggers a squeeze, prices can move in ways that seem impossible. They can gap beyond anything that models predict. They can break the market structure itself.